Hello and welcome to this Expert Insight session. My name's James Marley and today we're going to be talking about interest rates. And I'm joined by Simon Mullumby, who is the Head of Australian Cash and Bonds at State Street Global Advisors. So from that, the seat that you occupy, Simon, mixed signals around recession, soft landing, hard landing, no landing. From a fixed income lens, what's your take?
Firm belief is soft landing. I think that the RBA is in very capable hands, and I think that all the data thus far has shown that this 4% of monetary policy tightening that we've had thus far has certainly slowed things down. He's doing what the RBA is after, but it's potentially not enough. And given where unemployment is, still 3.7%, given where inflation is, which is still miles above the top of the RBA's explicit band, and given where growth is, the belief is on the desk that the RBA has more to do, and it won't just be one additional tightening, it'll be a tranche of tightening, maybe not in the short term, but certainly in the medium term, simply because unemployment is still so low and that is still such a stimulus to the economy.
Okay, so I take it from that, the view is the economy is in rude health, so to speak, and I guess that poses the risk of interest rates being higher for longer, as you've mentioned there.
Totally.
That's gone from transitory to being quite a central risk in your eyes, is that correct?
Absolutely. I mean, there were a number of economists and sort of market commentators subscribing to cuts at the end of this year and or next year from both the RBA and other central banks. But I think that given our belief is soft landing, given that the central banks are going about it with kid gloves, they haven't just broken the economy to bring inflation to within the band. Things aren't as bad as what a number of commentators were promoting. Yep. And to that end, there's more to do both here and offshore from central banks because they are doing it in such a soft, measured manner.
Do you have a view on what the RBA's terminal rate might be in this cycle?
Well, it's the million-dollar question.
Yeah.
Look, I mean, we're at 4.1 at the moment. I wouldn't be surprised if it goes higher than 4.5. And if you do subscribe to a tranche of further tightening, that would mean at least another 25, 50. So look, I think higher than 4.5 is where I'd be comfortable answering that question. Yep,
and I know they're difficult to put your finger on it firmly, but what about timeframes? Is this sort of we're in this pausing moment right now? Is this a first quarter, second quarter next year? How are you thinking about timing?
Yeah, timing's tough in that the RBA has been explicit. They're in this calibration phase, yep. And the calibration phase is they're calibrating what they've done to the economy because obviously monetary policy moves gradually, isn't a sharp, blunt instrument. It does take time to work. And in this calibration phase, they're going to see what they've done to unemployment. They want it at 4.5 by the end of next year. They're going to see what they've done to inflation. They want it sort of near the top of the 3% band by the end of 2025. But if you look at the minutes yesterday, the October minutes, they're a little bit worried that everything is going to be higher for longer. And indeed, rates could be higher for longer. I know that some people are out there saying higher forever, but certainly the data is strong. And during this calibration phase, maybe you won't see anything this year, but I think the chances of you seeing further monetary policy tightening next year is it's not certain, but it is certainly very possible.
Yeah. And in terms of the change of leadership that's taken place at the RBA, are you expecting that to have an impact on the RBA's mandate at all?
None at all. Everything that we've heard and read, Michelle Bullock, very good as a central banker, has obviously been under the guise of both Lowe and Stevens for all these years. So yeah, no change to, I suppose, the focus and the way monetary policy is enacted.
So we've talked about the higher for longer regime, the prospect of more rates.
Yep.
What are the implications for defensive portfolios in that scenario?
It's tough because duration is obviously risk, and given where bonds went over the last 10 years, our 3-year bond down to 0.1, our 10-year bond down to circa 1%, and where they are at the moment, and they are being sold aggressively and have been sold aggressively over the last 3 to 4 months again. Defensive assets it's tough because you think that when equity markets are being hurt, the bonds are going to save you. Both equity and bonds didn't do that well last year, whereas cash and short interest rate duration assets did. So from a defensive perspective, the belief on the desk is that the sell-off in bonds hasn't finished yet. So putting on long duration could potentially hurt again. So our preference is for short interest rate duration, but also we like credit, so good quality liquid credit.
And what about specifically, you've touched on how you're thinking about markets, how do interest rate hikes that we've seen, how do they change your ability to earn on your target of RBA cash plus 1%?
Yeah, look, on the floating rate portfolio, it's actually working very well because we only buy senior unsecured banks, which are performing very well, and they're always very liquid, so you can switch in and out of them to new issues in the market. And given floating rate notes reset over BBSW, when BBSW starts to price further monetary policy tightening and the coupon resets on top of that, the income targets are being met and some. So yeah, the notes are doing very well.
Alrighty, well, ladies and gentlemen, as you heard there, the higher for longer regime remains intact, and don't be surprised if there's more interest rate hikes coming down the pipe in 2024.